Hi, it's Kira from iAmPrediction, and today we're going to speak about risk and return. It's very important to understand what is risk and what is return before diving deep into the stock market and putting your money on the table. So, think carefully, what is risk? In finance, risk refers to the degree of uncertainty and or potential financial loss inherent in an investment decision. So, think about this. Does the graph between risk and return looks like this? Let's say that here we got return and here we have a risk, right? Let's put it this way. And here it's 24 degrees angle, which means that per unit of risk we get a unit of return. Is this how it works in real life? What do you think? The answer is no, it does not look like this in real life. In real life we have assets that has return but has no risk. So let's say that we have a bank deposit and it gives us 2% per year, right? For sure we get 2% per year and we basically has zero risk, right? Oops, zero risk. Okay, can this be called an investment? Well, we all have bank deposits, but we're not all investors, right? We get paid through our salary comes into our bank account and we get some kind of interest on our bank account, right? So is this person that does this an investor? Well, no, but if you think carefully, there are other assets that are considered less riskier, that are considered a little bit riskier, but they have a little bit higher return. So what are these assets? Treasury bills, let's say. What else? Mostly treasury bills and bonds. So we're going to discuss here an example with the bank account. We're going to consider this as investment, or let's say that we have an investment X, right? This is an investment X, which in bad times we lose nothing, and in good times we gain 2%, right? Actually, we're going to do something else. We're going to create a situations. Let's say we got situation A and situation B, right? So situation A is a very good situation because we're going to say that here the market is going up, right? So let's say that we have a stock L. Let's do it like this. We have a stock L, which in good times we're going to get a 80% return, and in bad times here we're going to lose 30%. And we're going to have this X over here, which in bad times, in good times, still get this 2%, and in bad times, well, still get this 2%, right? All right. So we've got these two, and now the question is, which one is better in investment? And you may think, well, Kirill, you just said that this one is not an investment. Sometimes saving is a better investment than the most products on the market. Keep that in mind. This is very important. So we're going to draw this line over here, and the answer to this question depends on how often A and B happens. Let's say that they happen 0.5% of the time or 0.5% of the time, right? Both of them. So then we can calculate the return by multiplying each of them and see on average how much we'll get. So it will be 0.5 multiplied by 0.8. Then we're going to subtract the potential loss. 0.5 multiplied 25%, right? 0.25, which is 25%. Okay. So, is this a good investment? Yes. If such things happen more often than the other, it is a good investment, right? If we have this kind of situation. But if this happens with a 90% chance, well, then it is not a good investment and we better stay away from it. And here we get a 25% return, but is this the real return? What do you think? Well, here we have a 2% return that does not cost us anything. We don't take any risk for it. So this is called a risk-free rate, right? Okay, so the real return would be this percent, 25% minus 2%, right? So we will have a stock that will give us 25% on average yearly return and 23% on average real return per year. Yes, this stock is a good investment because if you get 23% per year, you're beating most of the hedge funds out there, as their main target usually is 20% per year for most of them. Okay? And this is also called a risk premium, right? My handwriting is a little bit bad, but I guess you followed my steps and you got what I mean. So the risk premium is how much the risk cost. Here, from this type of investment, we cannot say how much the risk cost. Actually, it evaluates the risk. We can also use other types of risk, let's say, other type of indicators to define how much is our real return. For example, we can define real interest rate by subtracting it from the nominal interest rate, the inflation. Here we can also take inflation and get real return on the stock. And also, if stock pays dividend, we should also add other things. But this is a topic for another video. So this is all I have for you for today, guys. Feedback is always welcomed and we strongly appreciate it. Thank you, guys. See you soon.